This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. Now, for a guy who has cut his teeth on the markets and trading and investing, 5+ books, I'm always going to have an affinity for those market-related conversations. My guest today, Bob Greifeld, is the former CEO and chairman of NASDAQ. Now, one doesn't have to know too much about how an exchange works, but when you hear CEO of NASDAQ, well, Bob was at the catbird seat of a lot. He saw how technology impacted the exchange structure. He saw the financial crisis. He was right there living it, leading one of the most important exchanges in the world. Today, Bob and I cover an assortment of issues ranging from WeWork to the financial crisis in Lehman Brothers, to the Facebook IPO, to his view on China. A lot of different interesting perspectives from a guy who has sat at a table that most of us don't get a chance to sit at. I love doing this podcast. I love getting the opportunity to get under the skin, under the hood with people that are history makers, people that have had a chance to shape the markets, in a big way. Bob's one of those guys, and I appreciate him taking the time to come on this show and share with us all. Without any further delay, let's jump right into my guest today, Bob Greifeld. So, Bob, I'm pondering back to the 2002 time period. I remember at that point in time, probably the NASDAQ was down 77%, something like that. With this big dot-com bubble, boom, bust, all that kind of fun stuff. Then we have the financial crisis in 2008. And before I dive into your kind of world, I want to bring the audience into a really topical moment with you, because I think you're going to have some interesting perspective. As I lay that foundation, that 2002 bottom, then 2008 financial crisis, then we have a relatively straight up period of stocks, 2009 to 2019. People keep wondering, is this a bubble? Just recently, I caught this news of the WeWork, and I haven't really followed this baby, but then I had to dig in and I had to understand a little bit more about SoftBank and Masa and all these things. It's a quite interesting story, because here you have a company that was, before IPO, was talked about valuations of $47 billion, and then all of a sudden it's at $8 billion. The question I start to have to a guy like you who has seen all kinds of things, is this the tip of the iceberg? Are a lot of these private companies in the venture capital space that are not in the public markets yet, are they just obscenely overvalued like WeWork, or was WeWork the crazy unicorn?
Well, my personal opinion is WeWork is certainly the outlier. I don't think you'll see breathtaking drops between public and private valuations like we've seen here. But I would say this, two things with respect to WeWork. It is in some ways a line in the sand, in that it has definitely changed the psychology of the IPO market. I think now if you are trying to come public without a clearly defined path to profitability, your road will be quite difficult. On the other hand, if you are a growing company that is profitable or has a clear path, then I don't think very much has changed in the world there.
You think that kind of the hubris of trying to pull something, would you call it hubris, the fact that they got that close to going public when there was clearly something wrong there?
Yeah, so one, I would say I don't think they actually got that close. They clearly worked with investment bankers, and this brings up the point. Public markets have what's called open access standards, where everybody has to be allowed to come in, assuming the four walls of the regulatory structure, to buy and trade and have their own decisions with respect to valuation. Private market valuations, which the $47 billion came from, is an entirely different circumstance. In that situation, a lot of times the transactions are bilateral between two people. In that situation, it's very easy for one of the two people to have a wrong sense of value or willing to pay a wrong sense of value. So the odds of the valuation in private market world being wrong are certainly a lot higher than public market. Not saying the public markets don't get valuations wrong, but we saw an extreme case of this with WeWork. As they expanded the circle and brought in a couple investment banking firms, I think the valuations came down. I just read in the press like you do in the $20 billion range. Then when it expanded to the wider circle as they started the roadshow, that number was untenable. So they really didn't ever get close to coming public at a $47 billion valuation.
Before I dive into your world and take you back in time to the point in time where you became CEO of NASDAQ, I want to keep you at this moment in time where we're at right now, 2019. You were, the CEO of NASDAQ over the stretch that I'm about to talk about, 2009 to 2019. It's a pretty amazing decade of equity returns, isn't it?
It really is, but you're kind of cherry picking the time from the bottom. When I started in 2003, we had the depths of the market, the bursting, the dot-com bubble was fully upon us. The WeWork, to tie back to current events, is the closest thing we had to that, but it still was nowhere near the scale of what we saw in that era. In 2003, it really was difficult times, and that year we had 0 IPOs. So think about that. You hear a lot of publicity about the IPO market this year, where they've raised over $50 billion in the US alone. We had 0 back then. So it was difficult times. The coming of Google, their IPO kind of marked a change where we then started to head straight up, and we felt we didn't recognize at the time, but we clearly had a tailwind. The headwind has shifted to a tailwind, then we ran smack into the credit crisis. The markets collapsed, the valuations collapsed, and then after we started working our way out of that, you have, as you referred to, that great bull run from 2009 to 19. That's a great decade there. But if you go back to 2005 to 19, it's not quite as dramatic.
Let me keep you at this moment still, though, right now, because I think a lot of people, having touched the fire during the dot-com bubble, touched the fire during the financial crisis, probably feel like after watching even though I'm cherry picking from the bottom in 2009, they still look at that 10-year window and they say, up until today, and they say, gosh, is there something lurking back there? And that's why I brought up WeWork, and I could think of things like Madoff, or have we just had a great run and a guy like you that runs in interesting circles and talks to interesting people all around the world, what are the types of risks that could possibly black swan us again?
Well, I would say this. I mean, if your focus is on fundamentals, it's hard to get yourself in too much trouble. You certainly can have down periods. But if you look at the company as a stream of cash flows that you have to discount back to current day, you come up with valuations which will ebb and flow based upon what multiple of earnings people are willing to pay for that valuations. It's when you get into the non-cash flow analysis that you can, one, make a lot of money and or lose a lot of money depending upon the spirit of the times. I always look at the fundamentals. I certainly always look at what the earnings are, understanding in the accounting world, earnings can not always represent fact, and you have to look beyond that to cash flow. I look at what multiple you're paying for that earnings, and to me, most importantly, because I do like to invest in things that have growth potentials, I pay attention to what's called the PEG ratio, price earnings relative to the growth. So if a company is growing 20% per year, you certainly should pay a higher multiple of earnings for that, but there's still an upper bound in what you're going to pay, what you should pay, because we all understand that trees can't grow to the sky and you'll reach some saturation point in the chosen market.
It's interesting you bring up the fundamentals, and I think about the marketplace that you were the CEO over for a long period of time. I start to think about some of these quant traders, guys like Jim Simons at Renaissance, many others. From your perch at NASDAQ, that must have been a terribly interesting advancement to see the quant traders come in who really don't care about the fundamentals.
I would say they do in a second order impact. One, I'm chairman of Virtu today, which is, I think, a global leading trading firm. Clearly, there are temporary price dislocations in the marketplace. The marketplace then wants people to provide liquidity to basically smooth out those price locations. That's how trading firms can do well, providing liquidity to the market when liquidity is required to kind of balance out buying and selling at the moment. That doesn't have much to do with financials. That has a lot to do with the functioning of the market. It's important to recognize that function has existed before technology existed. Trading floors existed back in the day. So in the book, when we start in 2003, the trading floor still reigned supreme. You had people who came to work on the trading floor today because there were these dislocations in the market that they were there to provide liquidity, the oil to keep the machinery moving. And they did it by shouting back in the day. And then technology basically came in over time and then came to dominate. So the quant traders are on a more automated basis trading similar to how the floors did back in the day. Now, with the advance of technology and the advance of big data, you could have a different style of trading where you recognize not dislocations of the market of the moment, which the traditional trader did, but fundamental dislocations in the value of a company based upon imperfect understanding of what's happening in the world of the marketplace. So there's certainly people doing that today, and that would be, I would call it, a new profession.
As you give that analysis, are you also including in there your perspective on the high frequency speed of light trading as well?
Yeah, so that trading is more of, again, providing liquidity of the moment, recognizing pricing inefficiencies in the marketplace, supply demand imbalances they provide there. That would be the classical floor trader environment wrapped in today's technology garb. The longer term quant guys would be a new form of what I call active investing. Peter Lynch, back in the day, obviously had in his mind's eye the ability to spot companies that were undervalued relative to peers or the marketplace on some systemic basis. So now quants have the ability to work at and replicate kind of probably many of Peter Lynch's thinking processes from back in the day. I break it into two areas: floor trader replacement, active trader replacement, or using technology to do it. Most of the trading today, whether it be quant-based or speed trading, has a team of technologists with traditional traders working together.
Now, how much of this experience did you have back in 2003 when you took the CEO spot? You were a tech guy. You were not an exchange guy.
No, I was not an exchange guy, but I was certainly a tech guy. I still consider myself a tech guy. But I was able to see, and when I was the right hire for NASDAQ, I knew that tech would eat the world. I knew it would. Our customers were becoming increasingly automated, and they needed the exchange to be automated on the other side of it so they could express themselves with a like partner. These quant and electronic people are developing on the primarily sell side back then didn't want to be calling out to a floor broker or sending an order to a specialist. They wanted to have a computer that they could interact with back in the day. I had a keen eye with that. I talk about it in the book a little bit. So when I came to NASDAQ, I was very qualified on the transaction part of the exchange, the technology part of the exchange. I knew exactly what had to be done there. I knew what the customers wanted. I knew what the competitors were doing since I was a competitor. Where I was woefully underprepared or inadequate in the beginning was I didn't understand the government relations part of it, in that NASDAQ was regulated by the SEC, but then we had congressional oversight from both the Senate and the House. So you had to have a relationship with a number of senators and congressmen. So that was completely new to me. The publicity aspect of the job was new to me. The public-facing aspect of it, I was able to be successful and anonymous before that. Both those things I was not really qualified for.
Let me keep you at politics for a moment. I'm going to jump you around. Interesting to read how you write about it. It's kind of like, I'm not saying you use this phrasing, but kind of a necessary evil. You can't run from it. It's there. You got to deal with it. But paint a picture for the audience that would not have had a chance to be in a position like you were. when you are dealing with DC congressional types, look, it's a pretty divided place these days. There's the left, there's the right. Would these different sides cause you different issues? Were there different pulls that each side had that you had to deal with that you knew, for example, if a particular congressman was coming from the left or the right, they were going to pull at you in different ways? How was that affecting you politically that you had to deal with?
I would say this, that certainly there was partisanship, but I would say our topics typically were not by nature partisan. What was a unifying force of both the senators and the representatives from the House was their desire for fundraising. So I saw firsthand the money requirements there. When you got on financial services or Senate banking, you were able to have a pretty good funding source from the people you regulated. You had to do fundraisers and you had to do that on a bipartisan basis. So that was, again, very new to me. I remember when I was at NASDAQ a short period of time, one of my government officers, government relations people said, Bob, Congressman Oxley's very interested in getting together. He was obviously the co-author of Sarbanes-Oxley. I was kind of flattered, and then the guy said, don't get too excited. He just wants to make sure he has a relationship so he can raise money for him when the time comes. So that's stating it a little more harshly than it was, and Congressman Oxley got to be a great friend through the years, became our vice chairman. But I would say, one, their intentions were good to do the right thing. They had to always worry about the fundraising aspect of it, and this was a choice committee assignment. Getting back to your question directly, with the Democrats or the Republicans, certainly the partisanship was there, but it would be at a normal balance, not what you see in the general public today. It wasn't that hard for us to deal with.
I don't think anyone listening can apply a negative thought to your perspective. Here you are, the head of the exchange, something that I think generally people are all supportive of and understand the benefit to. It's not a good feeling to hear from your perspective, somebody who's had your experience, to just lay out so coldly the Senate and the House are spending so much time on fundraising. It sounds so terrible in a way.
Well, it is. It's not fun for them. It's not fun for us. I tend not to sugarcoat things, but that was a real aspect of the relationship. And then when they had committee hearings and they would question the witness, basically, they knew that was in some ways a payback moment where they would ask one of your questions to one of the witnesses. You're there. If I'm being questioned, then I know I'm trying to think, okay, who gave them this question? That kind of thing to ask.
Let me take you to a point in time, 2008. Let you paint the picture, the feeling, the emotion, the aha, the wow. That was when Lehman failed. Can you paint the picture where you were and what was going on? And I mean, did you instantly calculate in your mind, wow, we are now at the edge of the cliff and I don't know what's going to happen? How did you feel?
I do describe it in the book. I happened to be, as I call it, a garden party that evening, a Sunday night. It was CEO of a NYSE listed company that we were soliciting to switch. So it was a great social occasion. I had great fondness for Maggie, who was at her house. The news was breaking. Everybody was coming to me. I didn't have any special insight, but I remember saying, okay, this is not a small thing. We had Bear Stearns had failed before and the system held, but Lehman was just such a larger, more interconnected organization. They said the Bear Stearns parallel probably doesn't work. I was right on that estimation. We went into the unknown there. I don't think I had any special insight except knowing that, as kind of you describe it, we had just fallen off of a cliff. I didn't know how far down it would be. The dominant thought is, after you start thinking about the macro questions of what's going to happen in the world, you're captain of a watch. So it's okay, we have to be ready for what we have to do. With the failure of Lehman, you saw a completely different response between the credit and the equity marketplace. The credit market froze, where you could not get any transactions done, because that was fundamentally a bilateral deal where you had to trust your counterparty, the person sitting across the virtual table from you, to be fund certain in 2 days when you close the transaction. Now, that counterparty could have been good that day, but in 2 days, who really knew? So nobody wanted to trade with anybody. That market froze up completely. Now, the equity market, we had the exact opposite problem. Since we had centralized clearing, we had mutualized risk, and very liquid instruments, nobody was afraid of trading with each other. So we had to handle record volume. We were handling volumes that we had only seen or tested in the lab. Testing something in the lab is different than running it in real life as much as you try to simulate it. We had systems that were bending but did not break. It wasn't visible to the naked eye, but we'd open the market and the cascade of orders, obviously predominantly driven by the sell sentiment, was just overwhelming. Our system would really not catch up to almost 10 o'clock. That was fine, and that everything was done in sequence, just not as quickly as we wanted, and the systems never broke. So we were dealing with that reality come that Monday.
Speak to the issue of short selling. You make the point in your work, your book, you talk about the benefit of the reasons behind short selling. Beginners and pros alike, they can understand quite easily. But you make the point, and I would love for you to elaborate and perhaps paint a picture of what you could see as the optimal solution or path. But you make the point that during that particular type of crisis, and the crises are always going to be different in the future, but let's just say where something's really going wrong, is that the short selling at that moment in time, it loses its value perhaps compared to other points in time. Not necessarily losing the value for the person that's implementing it. They might be fine, but just overall, it's tricky in a financial crisis, isn't it?
Well, here, this was a great situation where you had your strongly held philosophical views coming into the pragmatic part of the moment. From an academic, not that I agree with academics all the time, but in this time I did. Every academic will tell you that short selling brings great discipline to the market. So if the market will not allow people to express a negative sentiment, it will be too positively valued. So short selling allows you to sell short a stock that, by short meaning that you don't own. So we were a staunch defender of short selling in the marketplace. It gives you the proper balance. And certainly shorts have done a great job ferreting out Enron and other companies that really were frauds upon the market there. So we believe in that. But now there's a lot of publicity about shorts, in particular with respect to the financial industry. Short sellers, if they gang up and attack a stock, maybe they can make it artificially low. I do remember very clearly being in my office with Chris Kincannon, who ran the transaction business for us. We see Morgan Stanley and Goldman Sachs, basically the stock price, we're looking at the screen, is just disappearing. We kind of came to the same conclusion. Okay, we believe in short selling, but why don't we just not support banning it for now in financial stocks? And it's just kind of like a belt and suspenders. We gave up our philosophical belief, supported the ban, put it in, and then it didn't seem to help. Obviously, a year or two later, when we had the data and all the economists were able to comb through it, we showed that ban on short selling really didn't impact the price in any meaningful way of these financial stocks. I'm not unhappy that we did it. Clearly, we're responding to the pressure of the moment. I think in terms of overall management lessons, you have your philosophical belief, but when does the pragmatism of the moment overwhelm that belief, and is that the right or wrong thing to do? Is a fun thing to think about.
I must ask you, with your first time we've chatted, your personality, pragmatism, the way that you sound, were you able to keep all of that going straight, keeping the level-headed mind during that period of time? I mean, how was the emotion for you? I mean, you said, look, you took care of business at the shop, took care of business at NASDAQ, did the things you needed to do. But were there moments where you felt the emotion was like too high for yourself? You realized, wow, I don't like this feeling.
No, I think that's one of my strengths. One, you always have to take everything in life, not just in business, but in context, and understand where it fits in. And that keeps you fairly steady. I would say this, that when I would go on an overseas trip and come home, not so much Europe, but to Asia and come back, I always had a sense that I was off. I was not on even keel. I would consciously not try to make any decisions for a day or two. I believe the quality of decision making is definitely tied to where you are. You well rested? Are you non-emotional? So I would do those kind of gut checks before I come to a decision, because just because you are a good decision maker doesn't mean you're infallible. And then you try to analyze, when do you get yourself in a position where you're not making the right decision.
I've got on my notes here of all the things. I mean, there's many things I jotted down here, but I did absolutely jot down because I can relate to it. Avoiding the big decisions with jet lag.
Yeah. Yeah. You must have some of that living where you do.
People that have not experienced what you just described back and forth between Asia and the States, and especially if you do it several times in short order, I mean, it's almost like a mind fog. You're not yourself. Something happens.
Exactly. You can think you're yourself, but you're not. So yeah, I was very conscious of that mind fog. And sometimes it's not a thick fog, but still, you're making a decision. Just wait a day there. And I also was a big believer of, if I was giving the data in the given day, I wouldn't make a decision that day. I'm a big believer that sleep orders your brain, and you come in the next day, you process it in some subconscious way, and then you're in a better position to make the decision.
I think you're probably in a good position to address, since you just brought up Asia, you're in a good position to offer some perspective. Obviously, you know quite a bit about NASDAQ and how the NASDAQ works. But would you compare and contrast? I would probably be more specifically asking for compare and contrast to Chinese markets. I mean, we could always talk about Tokyo or whatever, but could you compare and contrast to market structures, market operations across the exchanges inside China?
One is, at NASDAQ, one of the businesses we built was providing technology to other exchanges, in a real sense, that had the ability to democratize access to modern market structure. You could have been in China, in somewhere in Africa, you can buy our technology, and that represents the sum total of learnings we've developed over the last 30 years. So kind of fast forward you there. Now, in China, we were not able to do that for a variety of reasons. I think when I look at the Chinese market, it's still not a direct analog to the US market in any real sense, in that, one, it's a fairly opaque process in terms of how companies get to list on the marketplace. The market structure tends not to be an all market like you have predominantly in the States, but not exclusively. Then you have different access restrictions in the market that doesn't exist in the States. I think you see advances in the Chinese market, but it's definitely not an analog to the US.
Now, did they not have the desire to go down the path to acquire or adopt some of your technologies that you developed at NASDAQ? Was that not an interest, or were there other, perhaps political reasons that they did not go down that path?
It's a difficult thing for me to comment on with great authority, but I would say this: there were your standard IP concerns on our side that you'd have dealing with the Chinese market. It was difficult to get some of the proper IP protections in place.
You've got all this great decades and decades of experience. You're willing to collaborate with other countries, but if they don't respect the IP, collaboration's not going to happen.
It's hard.
Yeah. Let me take you to another interesting point that occurred in your career. I had to go back because I had really forgot the details, and perhaps some of those details were probably more on the inside. But it was a really big deal when Facebook came out. It was quite the quandary and quite the up and down period for you. Why don't you lay that case out and perhaps even start with, because you're probably, I mean, I'm sure he's met with a lot of people, but not a lot of people get a chance to spend time with Mark Zuckerberg.
Yeah, I would say that Facebook was not mostly up and down. Facebook IPO was down for me. So that was a bad day. It was a day that we had to learn from. To try to summarize, to me, when I wrote the book, it revealed to me the Facebook IPO was in many ways the completion of a circle. When I came to NASDAQ in 2003, we had a mainframe system that they updated once a year. And that update was engineered and quite reliable. All our upstart competitors, of which I was one, was updating their software like once a week and was unreliable. The system would die, they would reboot it and start again. We had to become more like them because that's what the customer wanted. They were rewarding the fact that they were getting rapid deployment of new features and, in a way, penalizing us for being the battleship. So we became more like them. I've always had great admiration for technology talent, and we put them in really positions of leadership. Now, when we botched the IPO, the easy thing in the CEO toolbook is to fire the people who were directly involved with that.
Bob, can you define botching the IPO for the audience?
What happened, and tell me if I'm boring people. All right, so the inside story is we had our software engineers, and I had a management phrase. I said, never let the perfect be the enemy of the good. We were trying to be perfect. That is, when we ran the IPO cross to actually open the market and trading in Facebook, let's say it took us a second to do that because systems are very fast. It was actually less than a second. But let's say it was a second. And in that second, 3 cancellations came in that didn't want to participate in the opening auction. We would then rerun the auction, processing those 3. But as we did that, 5 new cancellations came in, and we would then have the system rerun the cross again. Now, the good thing would have been just to say, okay, these 3 cancellations came in too late. Whether you liked it or not, your order is processed in the auction because we had a gate up and you missed it. The business side of the house, that's what they would have asked for. But I had put the technology people really as judge and jury there, and they designed it this way without the business people asking for it. The Facebook IPO basically went into a loop. If you remember, there was a lot of negative publicity going on about Facebook at that time, primarily for the thoughtful people. They had to really move from the desktop to the mobile, and so that was a big question in that. We basically were looping in a very public way. As I did the analysis, I realized that it wasn't that we had incompetent people. It was that we had over-engineered this thing, and we were allowed to over-engineer it because I put the engineers in with too much power. The business people said, well, we didn't even know they did it this way. We never asked for it. I had created the wrong culture where the technology people had too much power to do what they wanted. Now, if I'm doing a startup software company, I'm doing it this way, but NASDAQ was not a startup software company. In 2003, we had to act like that because that's what the market wanted, but the market had evolved. What's interesting, I changed the company more back to where we were in 2003, but not completely. Really, instead of firing the engineers because they were very competent, they all quit over the next 18 months or so. Because as we changed the rules of the game and made it more regimented, that was not that they wanted to do. They were supremely talented people. We saw a very strong evolution of culture, which we needed to have. People self-selected that they didn't want to be in this culture. The culture was non-negotiated. Certainly the engineers had lived in the world where they were kings, and now they were just part of the machinery, didn't have really any interest in it.
Well, because at the end of the day, you as the top guy, you knew what the end user, us, the investors out there wanted. We wanted what our expectations were, buy, sell. And the engineers, as you describe it, they wanted perhaps a certain level of autonomy and decision-making that didn't necessarily align with what the end users wanted.
Right. It's great to be a software engineer when you get to decide what features go in and how they go in. When you have then somebody running the transaction business say, no, you work for me, I don't want this feature that way, I don't want to build it that way. It's a different reality. We shifted back, we shifted the culture, didn't want to go all the way back to where the culture was in 2003 because nobody wants to release once a year, but we had to put more, I would say, a more rigorous methodology to how we do things. And then the infrastructure support, the operations people, the business units became equal partners to the engineers in the culture. That was a difficult time for me personally and also for NASDAQ, but we came out of it a stronger organization, and that was my goal. How do we live and learn through this?
Let me keep it at culture for a moment, the culture of innovation from your perspective. There's a video clip that I'm sure he's said this multiple times, but Jeff Bezos of Amazon talking about, hey, you see all of our wonderful products that are so successful, but what you don't see are all of our failures that never make it. And you make the point, you talk about 7 out of 10 endeavors that you're going to try are not going to work. This is right in the same headspace as batting average. If you hit 300, you're doing great. But it's very difficult for people to accept. And even when I brought up earlier in this conversation, we can talk about how WeWork was kind of like a bomb, but for SoftBank, WeWork was not their only portfolio constituent. It was just one of many. Why don't you speak to this idea, though? Because I still think for the average person or even the professional alike, having that portfolio mindset where, look, you're going to have a lot of failures, but what you're looking for are some big home runs to pay for the failures, right?
Yeah, I would say this, saying in the Valley, you want to fail fast. When you're doing a startup initiative, it doesn't cost that much money. Obviously, when you go live and you start putting customers on, that's where your burn rate increases. I always would say, I would ask people, what's the worst thing than having zero customers? And the answer is one customer, because you put one customer live, then you've got to put in that whole support infrastructure. When you're testing out a concept, doing some prototyping, reaching out, market research, talking to customers there, it costs money, but it's not a massive amount of money. The 7 that fail, you want to come to a conclusion on that quicker. By the time you go live, where you're committing to a customer that you're in this business and you're going to be there with them, you better have a higher confidence than 3 out of 10 at that point, because that's when you start spending some real money there.
And the flip side of that, and as we wind down, I'm thinking of a great quote, and I think this is from Charlie Munger that you put in your work, is it so many people, instead of having the mindset that you just described, cut those losers quick, don't lose a lot, lose small. You've got that great quote from Munger where he talks about 3 ways that a smart person can go broke. Liquor, ladies, and leverage. And I think that leverage part is really interesting. That I think ultimately probably any future crisis that might unfold, any future big event that might unfold in a negative way, I would hazard a guess that when we analyze it in hindsight, leverage will be lurking as a potential cause.
Yeah, no doubt about it. And that's when you watch for issues, when leverage creeps up. But I also say we had to violate that rule in the beginning. I did 47 acquisitions, 46 of them were optional. I had to buy Instinet. I did not have technology. I had an aging mainframe system. I did not have market share. The iNet platform owned by Instinet was far and away the best technology on the street. I talk about the origins of that in a basement in Staten Island in the book. But that time we were levered over 9 times at that deal. That was always, you got to pick your poison. Without that deal, I don't know if we make it. You live by the rules. You have to live by the rules. But if you're an existential threat, then you first have to survive. You survive the day. One time we were definitely swimming out in the water. I think this is Warren Buffett's line, without any swim trunks on. We're fortunate the tide didn't come in when we were getting the integration done. That was definitely redlining time.
Yeah, that would surprise people that don't think about the inner workings of an exchange and have heard the word NASDAQ for a long time. You just say, hey, if we didn't do this particular deal, we might have been out. It's kind of a surprising statement.
It was back in 2003. It was like, again, in the book, I'm here 6 months too late because I know I don't have a magic wand. We're losing money every day, losing market share every day, which was the more important thing. And we just didn't have the way to talk to the new electronic customers that had developed. Our systems were mainframe based and meant for a time when we had traders sitting on a screen and hitting the keyboard or clicking their mouse. That wasn't going to work for very long.
I got one last thought for you, Bob. Having gone through the book process, and I've done this myself many times, what's the personal satisfaction that you've taken from this? Like, what were the words? What's the most important thing that you put into this book that just you really thought like, gosh, I've got to share this? This is, I mean, clearly there's a lot of things in here, but is there anything in particular that really stands out that just really drove you, that you had to memorialize, that you had to get it down?
Let me answer the question a little bit differently than you might think. So one is I like to live in the present and also the future. So writing the book forces you to live in the past. So I had to think through really 14 years, and that was 18 months thinking about those 14 years in the past. That went against kind of every fiber of my being. It was a thing that I loved to procrastinate on. I required Maker's Mark and Diet Ginger Ale to get me done. That was my experience. Now, I think the payoff for me is in the years to come, because now I have this, it's memorialized, and I can read this 10 years from now when my memory is not as good, I'll have, I think, great satisfaction there. So I think I have this treasure I've developed that doesn't mean as much to me today as it will mean in the future. When you think about the time period, not to be too Pollyannish about it, but you just have to be grateful for the life you've been allowed to live. And it's an exciting period of time. Not every day was obviously a good day. There were plenty of bad days there, but all in all, I'm just grateful to have the opportunity to live that experience.
Hey, let me do one quick follow-up. What was your process for documenting yourself? Was obviously emails, you have all those emails, but were you keeping a kind of running diary or anything? Were you recording yourself? How did you keep that memory for 15 years dealing at the highest levels of business?
The closest thing I had to a diary was before board meetings. I would always write down my notes and cover the important things that had transpired. So I really didn't talk to the board that often, but when I did, I wanted to be comprehensive. So that was the greatest source document I had. Second was I have a very strong memory. Third, I had colleagues I could talk to for filling in the blanks here. So between the semi-diary, strong memories, and colleagues who had either notes or strong memories themselves were able to get to it. And I did live in moral terror of writing anything down that proved to be not inaccurate, but not fully reflecting of the situation. So we spent a lot of time making sure that we got all the facts right.
The book, Market Mover, Lessons from a Decade of Change at NASDAQ. Congratulations on the work. You've got some great reviews here. Larry Summers, John Chambers. I mean, you can't get much bigger than that for positive praise. Congratulations.
I appreciate that. Good talking to you.
Absolutely. Take care, sir.
All right. Thank you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.